Hey everyone, today on the final bar, my guest is Todd Sohn joining us from the New York area from Strategas Securities, trying to hopefully help us make sense of this relentless uptrend in stocks. It's a bear market rally as I've labeled it for so long, but it's feeling less and less like a bear market rally and just a rally. But we're nearing all of those points, those key resistance levels where people are expecting some sort of top. So we'll have to see what's coming next. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the chief market strategist here at StockCharts.com in Redmond, Washington. Thanks for joining us every weekday after the close. Break down the technical price action, the activity of the day, try to connect the short-term movements of what we're seeing right now versus the long-term trends, and hopefully be on the right side of things more than we're not. It's funny. I've talked with so many peers over the recent weeks about just this relentless uptrend, as I described it before, and I've labeled this a bear market rally. So often it feels as this rally continues and continues to mature, continues to go higher as we continue to see stocks resolving to the upside. We see days like this with the S&P up 2.5+%, but with mid caps and small caps up even more. You have to start to wonder, at what point does this uptrend end? And I'm excited to hear what Todd Sohn has to say, because I think it's one of the questions we're all sort of struggling with. How do you position yourself now going forward, now that we've appreciated so much? So we have Todd to help us today. We have a lot of other guests here on StockCharts TV and on the final bar in the coming days to help us try to answer those questions. Tomorrow, my guest is Greg Gunther from Agora Financial in the Baltimore area. Next week on Monday, we have our next episode of Behind the Charts. That's our interview style show. It's going to feature a conversation with Sam Stovall. I've known Sam for a number of years and actually met him originally through Ralph Acampora, one of my mentors. Sam is a strategist. He will admit he is not a technical analyst, but has a technical input into his process. And it reminds me of other strategists that I've always enjoyed talking to, because it's great to see how their perspective, thinking of the big picture, relates to the charts. And so a great sort of behind the scenes conversation with Sam. On Tuesday, we have Samantha Leduc. On Wednesday, we have Jonathan Krinsky. And then our next episode of The Pitch will be on May 13th. That's one of our newest shows, where we feature a conversation with three strategists bringing their top ideas, presenting them to you, and then having a discussion debate about what sort of themes that we're all seeing there. So a really good show coming up on May 13th. Let's get to our market recap. So, I had this conversation with Craig Johnson yesterday on the show. If you missed it, I would check out the video. He talks about the S&P going to 3,600. And after the cameras were turned off, we continued our debate, had a gentleman's bet about where we think things are headed. But Craig is certainly on the bull camp and has legitimate reasons as to thinking that we're going to resolve higher eventually. But again, I balance that with so many other conversations I've had thinking of this as a bear market rally in its latter stages, right? We've appreciated to that level of resistance between 50 and 61.8% retracing of the way of the downtrend from February to March. But a day like today, we just continue to go upside. So we have earnings, which could be plenty of catalysts for us to go lower. Today was not the case, right? We sort of had this nice stepwise motion. We pulled back a little bit in the last 30 minutes, but overall finishing very much in a position of strength with the S&P around 29.39, 29.40. Mid caps, small caps up even more than that. The VIX now almost to 30, and it was 80 not too long ago, 6 weeks ago. We're talking about this extreme explosion in the VIX with volatility going above any previous bear market cycles, and all of a sudden we're right back almost over halving where we were just a couple weeks ago, it feels like. So here's the daily chart of the S&P. Is my main go-to chart that I'm looking at. And again, what is so important is we're hitting this confluence of levels, right? This 50% retracement was here, just around 2,800. The 61.8% retracement of the February to March sell-off is right around 29.35, just below 29.50, and we're not far off from there. That's one big up day away, if not less. Above that, we have the 200-day moving average looming large around 3,000. So again, this confluence of levels where, again, if you buy into the bear market rally thesis, we're kind of there. And I've had a lot of people, Elliott Wave analysts, others, all describing why we're at that point. But until the market goes down, we're in rally mode. That's by definition, right? So we continue to make higher highs. We continue to make higher lows, which is why on the short-term tactical time frame, I think it's very difficult to be too negative as stocks continue to go higher. The RSI, as we've talked about, usually would top out around 60 in a bear market phase. That's what we saw back here in September of last year. And so again, we're right at that point where if this is a bear market rally and we're at the later stages, is about where it should be. We're going to look a little later at some individual stock charts, and we'll see how, again, it's just they're very constructive patterns emerging in a lot of different places. We're going to come back to some of those themes in a minute. I did want to just wrap up our market recap, focusing on some of the other themes that we saw. So energy actually number one, up 7.5% today. And as I screened for dividend players, our segment later is called Dialing Up Dividends, where we focus on income opportunities. It was actually really challenging, and those of you that do focus on income have probably seen it's pretty challenging because so many companies are slashing dividends, cutting dividends, taking a hiatus from dividends. And with others, there's the uncertainty of whether that's going to happen tomorrow, right? A stock like AT&T, which has given no signal of any sort about reducing a dividend. And one of the articles I read was just, what would it possibly take for an AT&T to cut their dividend? But you never know. I mean, this is the situation that could happen if things play out in a certain way. If things get more challenging, you could see companies continuing to dial back. So a lot of the stocks that I screened on still show a good dividend yield, but again, they've cut their dividend. So it's looking at the annualized dividend, which is still okay, but certainly doesn't feel like it's going to get better. The reason why I'm telling you all of this now is because a lot of energy stocks actually screen pretty well. If you're looking for stocks with a decent dividend payout, a decent dividend yield, where you're going to get a good income from your investment, it's a lot of energy stocks. However, there have been some in there that you're concerned, obviously, about their ability to continue to pay a dividend or keep it stable for sure. Number two, communication services. Number three, technology. And as we've talked about earlier in the week, big earnings week with some of the FANG names reporting, Facebook, Alphabet, both this week. And so again, with that sort of mega cap, MAGA trade or FANG trade, however you describe it, a lot of companies there reporting. And a lot of the charts of those companies have been a little more on the struggle bus than not. Amazon comes to mind as something that had a bearish engulfing pattern. We sort of followed through to the downside. A nice recovery day, though, today, up 2.5%. So some of these stocks that did feel like initially rolling over, actually having a nice bounce today with comm services and technology 2 and 3. At the bottom, we have all the traditional defense, utilities, consumer staples, real estate. At the bottom, utilities actually down on the day while the market was up pretty significantly. I think it was interesting to note healthcare down here. Healthcare is sort of I don't think of it as traditional offense. You don't think of it as traditional defense, kind of its own thing. And that's how it's felt for a while. Looking at the relative rotation graph, healthcare has actually been the strongest place now with a lot of the groups doing very, very well. So interesting to see that sector not doing as well as some of the other sectors today. The real strength came elsewhere. What's funny, though, is with all of these great stocks doing so well, and so many, with energy, with communication services, with technology, all doing well today, what's the number one stock out of all the stocks out there that we rank as part of our large cap scooter rankings? It's a gold stock, Newmont Mining. So even though, again, there's plenty of juice in other places, you can see AMD, Regeneron, Market Access, MSCI. So there are financials up here. There's technology. There's Amazon and Netflix, some of those mega cap consumery technology names. The gold stock is number one, Newmont Mining, scoring the best on our aggregate technical model. In terms of other things, and again, I'm sorry for sort of jumping around a lot. I feel like this day has sort of fueled a lot of questions in my own mind, just thinking of different ways to try and slice things. So starting at the bottom of the industry groups today, we have groups like tobacco, which had actually been improving, and again, still okay on a price basis, still right at its previous highs, but coming off after threatening to make a new swing high, from a couple weeks ago, actually finding resistance here. A lot of groups within staples, besides tobacco, you have soft drinks as well, potentially making a lower peak. This is at a time when other groups are doing much better. Pharmaceuticals have held up very, very well, but again, one of the worst groups today. Defense within industrial is also one of the lowest 10 stocks. In terms of what was really moving higher, it's a lot of energy groups that were gapping up big time today, or at least appreciating. E&P names, exploration and production, up over 10%. Oil equipment and services, up over 11%. So again, there's such a crazy disconnect between where oil it has been going and where it appears to be headed, and the strength you're seeing on some of these energy stocks. Also, airlines up over 9%. Again, a group like that, I'd hesitate to draw too many long-term conclusions from one day, but again, a series of days like this create a pretty decent uptrend. And looking at a chart of airlines, again, they're coming out of a very low level. If you think in terms of risk reward, though, and if you see the market recovering, and if you see things getting better, and you start to see how things are going to be rolled out, and you see optimism, groups like this that have been so beaten down, these are the ones getting the bid: the energy names, the airlines, and so forth. So quite the transition that you're feeling with. Again, I feel like the stages of a bear market rally, we're either at the end of it, this is the final gasp where people are piling into the FOMO trade, or this is giving you fuel for much further upside, and people believe that there's staying power to this uptrend. We're going to take a quick commercial break, be back with my guest, Todd Sohn from Strategas, hopefully to help us try and make sense of where we're headed to next. We'll see you in a minute. Hello, everyone. Welcome back to the show. I'm your host, Dave Keller, here at StockCharts.com. As a reminder, we love to answer your questions. We had a mailbag segment yesterday answering some really thoughtful questions from some of our viewers. We'd love to answer your question in our next mailbag segment later this week. So just shoot us an email, thefinalbar@StockCharts.com, or look us up on Twitter @FinalBarSCTV. Just tag us in a comment. We'll capture those as well. And again, we'd love to answer your questions on our next episode. Anything is fair game in terms of market dynamics, in terms of technical analysis, behavioral finance, whatever it is that enters your mind, pop them in there and we'll answer them. And speaking of questions that need answers, I'd love to bring on my guest, Todd Sohn from Strategas, joining us from New York City. Todd, welcome to the show, my friend.
Thanks for having me, Dave.
Absolutely. So, just before bringing you on, before the commercial break, we were talking about this environment where, people have been so focused on a bear market rally, but we've appreciated so much out of the lows. So the question is, have we gone up too much? Is this where you start to take profits if you had perfect foresight and bought at the lows? Or, what is your toolkit telling us about what's coming up next? And you said your first chart was on looking at the Nasdaq 100 ETF, the Qs. What is this telling you?
So with the Qs, right, they've been a leader through all of this. They're one of the best, if not the best chart out there that we can find, right? I don't necessarily want to fight this, but we believe that there is some tactical risk brewing here. And that's because if you look at flows into the QQQ fund over the last 3 months, they're at the highest we've ever seen, 10 billion into the fund. Some of it may have been created to short the fund, but generally speaking, there's been a herd movement here towards tech and healthcare. And so we just want to be mindful that there is tactical risk, perhaps not in absolute terms, but relative risk too, that if you are benchmarked, whether it's the S&P or whether this, that you may want to start to consider lightening the load, right? We're seeing reversion play out, as you mentioned, with some of the energy stocks and airlines that, maybe over the next month or so, we start to see those beaten down corners, the financials, energy, portions of retail start to outperform as tech and healthcare take a back seat. I just want to be very mindful of that.
Very interesting, and I think you're very keen on the fact that it certainly felt like there's this FOMO, right? This fear of missing out, and I think the picture of the flow certainly appears to support that, right? People sort of gravitating towards something like the Qs, something like technology that is that has worked so well. Chart number 2 is actually looking at sector weights, which I thought it was a very fascinating visual. What is this telling you?
Yeah, so I think an overlooked development of this environment, whether it's a bull market or a bear market, we'll determine at a later point, is that you've seen sector weights, intra-sector weights, really accelerate and exacerbate in both directions, right? So the chart here is just showing what the largest stock weight is in the industrials and tech and discretionary over the last 30 years. And so what we've seen is, as these corners of consumer have just been decimated, Amazon's weight has jumped to 40%. It was 30% after the restructuring of the sector a few years ago. So that's monumental now if you're just buying the, say, the discretionary sector. You now have Microsoft and Apple combining for about 40%. Microsoft's the largest weight there, I think at about 21% of the index, and that's growing. And then on the other side of things, the declines in, say, General Electric and Boeing, which have just been historically spectacular, have completely altered the makeup of the industrial sector. So now the largest weight is UNP at about 5.5% or so. That's nothing compared to what Amazon and Microsoft are in their own individual sectors. So it leaves you with an industrial space that is super diverse. If you're an active stock manager, that's pretty good for that sector. But I would also ask, in another aspect, is what role does the industrials play in the next cycle? Are they going to be that important as they've been historically? We're now just moving towards this structure where these mega cap names are going to end up making up the bulk of the index. The chart's going around where 25 stocks make up 20% of the S&P now. So that's just some stuff to ponder here. But I think more than ever, we need to pay attention to what our ETFs are made up of at this point.
That's a fantastic point. It's so funny when people look at something like the XLK, right, for consumer or for technology, or the XLY for discretionary, they usually just assume you're getting a diverse exposure to certain types of companies. But if you look at the weightings, you actually have some super narrow bets on a handful of companies that are driving the returns there. And arguably, right, with the same thing with the S&P 500. And that leads me to my next question, maybe. We've had this situation where the S&P continues to go higher. You could argue up until now, you showed a chart of the Qs. There are these mega cap tech names, for example, like Microsoft and others that have been really driving things higher. But the market continues to go up, so it doesn't seem to be a problem. Is that a necessary part of this? Exit from a bear market phase is that you have a broader participation, or so things like mid cap, small cap starting to do better because they've been underperformers for so long, or is it okay if we continue to have narrow leadership? Is that a challenge for further upside, or do you think that's just a descriptive sort of nature of what the market is going to be now?
I think that those names can carry the index further, but if you don't start to get stronger and stronger participation down in the cap scale, eventually it becomes a problem. If we want to make a sports analogy, I'm sure everyone's watched the Chicago Bulls documentary. Jordan is basically our mega cap names, right? At some point, a guy like John Paxson has to hit a shot to win the game, and that for us is small caps, it's banks, it's broken down retail. They eventually just need to do something here to help keep breath afloat. And I think you're starting to see subtle signs that that's getting there too. The new high data is getting a pinch better by the day. So as long as that continues, I'm okay with these big names putting up the numbers they are, as long as the rest of the space is also contributing there. So I think that's going to be important as we make our way into May, into June and July and so on. So we'll be keeping an eye on that most importantly.
That's a great take, Todd. Listen, thank you so much for coming on the show. Best to you and your family. Stay safe, and look forward to having you on again down the road. All right.
Same to you, Dave. Thanks a lot.
That was Todd Sohn from Strategas in New York, and I didn't want to ask him too much about his family while we're on the air, but I know he's in New York with a young child, and certainly wish him and his family the best as we're all navigating through things. I think his take is spot on, and I love that chart showing the weight of the largest names in some of these ETFs. Again, I think a lot of times when you buy an ETF or when you're looking at an ETF, you assume a broader exposure that may or may not actually be reflected in what's in there. So I think It's one of those classic caveat emptor, let the buyer beware. Make sure you're aware of the exposure that you're getting, because a lot of times could be a lot of unintended bets you may not expect to be making with some of those instruments. We're going to move on to our next segment called Dialing Up Dividends. And as I mentioned earlier in our market recap, and I'm thinking of dividend performers, I'm looking at stocks that are paying a decent income, stocks where when you own them, you can rely not just on the capital appreciation component, the price going up, but also the dividend component, the total return picture, which is the price plus the return on the dividends. This has become a quite frustrating area to try and screen for ideas recently, mainly because of the fact that so many companies are starting to adjust their dividends. And again, it's if you follow the news on it, you can see what's kind of coming up, but it's hard to anticipate where that's going to come from next. I think you had a big run of companies sort of adjusting their dividends, and now it's certainly an uncertain space. So one of the screens that I put together, and appropriately named just dividends with an exclamation point, was looking here. I was looking for stocks with a high scooter ranking, and I started with 90. You can obviously put whatever number you want. We'll bring it at 80, so it's in the top 20%. This is basically looking for stocks with a certain market cap. We'll start with that. We'll say a yield over 5, which means an annual a dividend yield over 5%, meaning you buy the stocks and you get at least a 5% payback from the dividend component. It's not a bad screen to start with, so we'll run that screen. Only 4 stocks that come back, right? Not too many. And again, what's interesting is as you start restricting this, one of the challenges with screens is where you put all these different levels. So without tinkering too much into here, my point here is it's actually hard to find a lot of companies paying strong yields with a high scooter ranking at the moment. And the scooter ranking, StockCharts technical rating, meaning a stronger uptrend, and with the yield so high. And the reason why that's a tough combination is because looking for a high scooter ranking, you're looking for stocks in a decent uptrend, right? That means it's in the upper percentiles, the upper 20% of trends if you look across the space. Yield means you're paying a high dividend relative to the price. So the lower the price, the higher the dividend yield is naturally going to be, because no company that I know of is consistently jacking up their dividend right now. They're keeping it stable or reducing it at this point, right? So it's a tough combination, and only 3 companies actually return for that. Apollo, APO, which is in the financial sector, British American Tobacco, BTI, and Kraft Heinz, KHC. This is Imperial Brands, which is traded in London. So only 3 stocks in the U.S. So a couple other ideas of things we could look at. Number one, we had a segment back on March 7th, which was an article in Barron's looking at consistent dividend payers. And it's interesting. This is right as things were rolling over, and it was, these are stocks that should be able to continue to pay a pretty good dividend. And it's not 100%. There may have been stocks in here that have flustered. But if you missed that episode, go back to our March 7th episode. You can look at some of the charts that we looked at there and see how they've evolved from here, and see if there are any opportunities within some of those names. What I wanted to do though is look at an ETF. So this is an ETF called NOBL, Noble. And if you're not familiar with it, it's a high dividend payers ETF. It's actually called the Dividend Aristocrats. It's an ETF through ProShares. And I'm going to look at just the performance here, and then look at some of the largest holdings and see what sort of opportunities we can come up with. What's interesting is if you take NOBL Noble as a proxy for high dividend payers, and again, it's not perfect because these are companies that have paid consistent dividends for like 25 years. So this is a basket of relatively value-y names. And again, in general, the growth stocks have done well, but you can see that even this ETF has rallied pretty well, while the relative strength is relatively stable since the market low. So it's sort of reacting along with the overall market, but just recently breaking out of previous resistance and holding up there okay. So what I want to do is just look at some of the largest names in here, see what sort of patterns we can come up with. So what you're not going to be probably surprised to hear, there is plenty of consumer staples represented. The challenge with something like Clorox is there's been a big rotation away from consumer staples. We talked about that earlier in the week. And again, something like CLX making new relative lows. So while it's a good dividend payer and the yields come down a bit because the stock is down, but so it's just paying over a 2% yield. But again, the price is what concerns me the most, right? It's still holding up okay. It's still in bull market mode with not having gone below an RSI of 40, even with this market disruption. But what's happening now is it's pulling back as other stocks are starting to really emerge as leadership in the last couple of weeks. Next is Walmart, WMT. And again, some of these yields may not look as attractive as others, and that's because so many of them have sold off so much that the yields have ballooned. Walmart also in consumer staples, gapping down today, so down over 3% today. And again, what concerns me here, making a new relative low. So as you go through some of these largest holdings, I think you want to stick to things that are actually more in a constructive pattern. Abbott Labs maybe comes to mind. So this is stock, again, a consistent source of income, a consistent dividend payer. This is one that's actually broken above its high from January, made a new high a couple of weeks ago, has pulled back. And if you buy into that concept that resistance becomes support, it's pulling back to that sort of, arguably buyable level of pulling back to a previous resistance level. The relative strength since the mid-February point overall is much higher. It's outperformed the S&P by about 18%. It's given a lot of that back in the last couple of weeks as other places have emerged, but again, still pretty compelling. And then the last one I want to bring up, and then we have to wrap up, unfortunately, is S&P Global, SPGI. I was actually interested to see this on as one of the largest holdings in the dividend aristocrats. And again, some of these yields, this is a yield of 0.81, so it's not a great yield, but when you compare it to a yield of 0 on a savings account, it's still a little better. What's fascinating about this is you have a consistent dividend pair with a relative strength profile that's been consistently positive. So those are some of the largest holdings in NOBL, the Dividend Aristocrats Index. And again, the benefit of those names arguably is the stability. These have been stable dividend payers for a longer period of time. I would say, though, if you start screening for stocks with decent dividend yields, you're going to find things like AT&T with a yield 6.5%, which is pretty solid. This is up or down a bit in terms of yield from the lows in March, but still holding up okay. The challenge here, again, as with many of these high dividend pairs, is the relative strength has been challenged. This is one of the, obviously within communication services, one of the more conservative parts of the traditional telecom group. But testing a 50-day moving average from below, we'll have to see if it's able to maintain that and hold it up. And again, the question with all these high dividend pairs in terms of high yields is whether that's going to be consistent going forward. And that, I'm not sure anyone can tell you for sure what's going to happen there. That's our segment, Dialing Up Dividends. And sorry, that was a mishmash of ideas, but as I was screening, that is an accurate reflection of my process about 2 hours ago as I started looking through ideas here and realized the insecurity, the instability in some of the dividend payments going out through the rest of the year, given the uncertainty in what's going on. Uncertainty for companies is certainly something to be aware of. We need to move right on to our final segment, the 3 and 3 charts. 3 minutes. Here we go. Chart number 1 is the USO, the U.S. Oil Fund. We talked about this earlier in the week. It was interesting today. The reason why it popped up, it just did a reverse split, an 8-for-1 reverse split, which means if you look at this chart and put a little underscore before the ticker, underscore USO, you'll see that it went from below $2 all the way up to 18 overnight, basically, or that's what it gapped up to. If you look at the adjusted version, which is what we're seeing here, we're at 18. We fill and adjust all the previous prices to adjust for the split. That's how we normally look at tickers on stock charts. So again, I think that things don't go on an 8-for-1 reverse split when things are going well overall for an asset class. Chart number 2 is looking at advancers, decliners. We looked at this yesterday because on a down day, on a down close, you had over 70% of stocks closing up on the day, and that is why I'm not surprised that we had the upside follow through today. By my read, right about now, 87%. It's not quite a 90% up day, but it's certainly telling you most stocks were up pretty significantly. Only 12% of names on the New York Stock Exchange down on the day, so certainly a broader-based rally. And again, my concern is that's more of a last gasp effort, sort of this last move higher as part of the bear market rally. Finally, looking at different sectors, looking at consumer discretionary versus consumer staples. Amazon is a big weight in the XLY, as we were talking about with Todd, breaking to new highs, but that's a lot of Amazon strength in there. If you look at the equal weighted version, though, same thing, and that's the challenge. One of those consumer staple stocks overall have been doing so well, but now starting to roll over on a relative basis where consumer discretionary is stepping in, suggesting further upside from here. Ladies and gentlemen, that's our show for today. Thanks for joining us for the Final Bar every weekday after the close. Special thanks to my guest, Todd Sohn from Strategas. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.